Now we've got a market that just went through this huge volatility event, one of the biggest in 10 years. Give me your kind of 60-second take on what do you think happened?
Well, and obviously the markets were reacting to what happened the night before in Japan. You have, 12% decline in the market like that. Generally, you're going to have a sympathetic sell-off. And I think you had people coming in, just to buy the dip. But I think they're missing the bigger picture. Even before the events of Monday, we've been having a rotation kind of quietly, and it's accelerated last week out of momentum type stocks into value stocks. Probably been going on for a couple of weeks, and I think that's because investors had started to correctly price out a soft landing. I mean, the recession. We've probably been in a recession all year. We've just been in denial. They try to hang their hat on the low unemployment numbers, which are a fiction. Even if you take the government's own U6 number, it's 7.8. That's what we got on Friday. That's a high number. Remember, up until 1994, the only unemployment rate we used was U6. And if you look at unemployment for the 52 years from 1994 going backwards to 1942, there wasn't a single year where unemployment ended as high as it is right now. So we have a lot of unemployment. Now we have a lot of inflation. The economy is in a lot of trouble, and it's going to get worse. And so I think the market is starting to price that in earnings. But what they're not pricing in is the resurgence of inflation, because that's coming too. The Fed is going to be cutting rates. Maybe it'll wait till September. Maybe it won't. But it's going to be cutting rates not because it won the fight against inflation, but because it lost, and because it has to prop up the economy, prop up the government, prop up the debt bubble. And so stagflation is here for the duration, and it's going to get a lot worse. And I think the markets haven't priced that in. I think this rally we're getting today, this turnaround Tuesday, is not a rally that I would trust. In fact, if you're looking for a bigger bounce, it would have been better if we had a big decline this morning that took out Friday's low, and then we rallied later in the day. I think this is just a good opportunity to sell these overpriced momentum stocks into the rally and keep buying the value names that I think will do well in stagflation. And remember, stocks do provide a hedge against inflation, just not really expensive stocks. They benefit from low interest rates and low inflation. But when real rates fall but inflation picks up, that's not good for those stocks.
When I look at one of the bigger value ETFs right now, you've got a lot of cyclical stuff in there. You've got banks, you've got industrials, you've got the home builders and the stuff connected to regional banks. In that rotation you were talking about, which I agree, that was really kind of the first breakdown in the market before the whole currency stuff with the yen. That goes back to July 10th when inflation came in light. A lot of that rotation stuff is pretty cyclical, Peter. So if you're right about the economy taking a hit, why would I go into the stuff that's cyclical?
Well, no, I didn't say cyclical. You don't want to be in the cyclical so much as the more defensive value names.
Okay.
So you want to own companies that produce products that people buy all the time because they need them. They don't buy them if they can afford them, because a lot of Americans aren't going to be able to afford things. I mean, inflation is wiping out their purchasing power, and they're broke. They have little savings, and I am expecting a major dollar decline, especially when the Fed starts to cut rates and when it goes back to QE. Because what the markets are completely missing is that the next time the Fed cuts rates, I think you're going to see a backup in the long rates. So I think the yield curve is going to steepen, and I think long-term interest rates are going to actually rise, and that's going to confound the Fed and create a bigger problem, because then you're going to get upward pressure on mortgage rates, not downward pressure. And I think the Fed is going to be reluctantly forced, or maybe not even reluctantly, to go back to the QE well and print a lot more money to try to buy up the bonds that nobody wants to hold in order to keep long-term yields from rising. And of course, that's just going to kill the dollar, send commodities soaring, and that's going to show up in the price indexes.
Peter, okay, so some of this seems like it doesn't track with the market, though, because right now you got people buying bonds hand over fist. In fact, when the yield curve was steepening out and we were getting term premium problems about a year ago, the dollar was doing pretty darn well at the time. Now the dollar's down, to your point. You got some of that dollar sell-off you've been looking for, but everybody's buying treasuries hand over fist. The term premium problem has disappeared. It seems like we got no problem selling bonds right now.
Yeah, well, because everybody is making a mistake. They're expecting the bond market to rally the way it did when the Fed, started the last couple of easing cycles, or even when it did QE. But when the Fed was easing in the past, it was doing so when inflation was below 2%, and they were able to use that as a cover. But when they start easing, and even more, important, when they relaunch quantitative easing, when inflation is well north of that 2% target, that's a whole different ballgame. And I think everybody has already crowded into the trade. Everybody has anticipated the rally in bonds, and so we've already had it. And so when the Fed actually cuts, I think that's going to be, a sell signal, and people are going to be selling the fact after having already bought the rumor. But as inflation picks up, bonds hate inflation. So high inflation destroys the value of bonds. It destroys the value of the income that you get, and it destroys the value of the principal that you hopefully eventually get. So I think we're, the bear market in bonds, which really started in 2020, that was like the peak of the bull market that really started in the early 1980s. It was a major, major bull market in bonds. I think we're now still early in a major bear market in bonds. And so bonds are going to get killed, and rates are going much higher. And when the Fed eases, that's probably going to be the catalyst to start the next leg down in bonds and up in long-term rates.
Okay, so that's the big call that you're making right now, basically short bonds after this huge rally. Because a lot of what you're describing seemed like a more imminent risk like 8 months ago when we were still printing real sticky inflation, maybe a year and a half ago when stocks and bonds were getting slammed together. I mean, CPI came down from 9 to 3. I know you're not a big fan of some of the popularized inflation data, but should the Fed not get some credit for being willing to sacrifice the economy to bring those inflation measures down?
Now, the Fed gets no credit. First of all, they lit the fire, so I'm not going to give them credit for partially putting it out. But it was more a function of the rise we got in the dollar early on, the pullback in commodity prices. The Fed never really cut back on credit growth. And money supply is growing now, but credit, consumer credit is at all-time high. Household debt, credit card debt, all-time highs. Government borrowing, record highs. In order to fight inflation, you have to raise interest rates high enough to stop all that borrowing. And the Fed didn't do that. They stopped raising much too soon. Rates should have gone a lot higher than they did. So the Fed basically surrendered its battle against inflation because it was too afraid of the collateral damage in the economy and in the financial markets. And the fact that inflation has come down from 9 to 3, it's more likely to go back to 9 than down to 2. And in fact, it's not going to stop at 9. And when it's 9, it's really 18 because the government probably reports about half the inflation that they create. But what's going to be so much different about this recession that we're in, and that's going to get worse, is unlike past recessions, it's going to be accompanied by rising long-term interest rates and high inflation. Okay. And that's what's going to make the recession much worse. And the Fed stimulus isn't going to work. It's actually going to turn into a sedative because higher inflation and more upward pressure on longer term rates is just going to take a bad recession and make it a depression.
All right. Well, we've got some stuff that we can definitely keep tabs on now from those calls, the short bond, the inflation roaring back from where it's at. Peter, before I let you go, though, I love to chat some Bitcoin with you. Are the coiners not being appreciative of the lower highs and lower lows in Bitcoin over the last 3.5 months here?
Well, it's actually worse than that. I mean, they're whistling past the crypto graveyard. If you look at the price of Bitcoin in terms of gold, which is the best way to price pretty much any asset, but especially something that tries to market itself as a digital gold.
Sure, that's fair.
Bitcoin at its lows yesterday was down about 45% from its peak in terms of gold almost 3 years ago. And even now, it's still, maybe 35% or more below its peak. So we've been in a stealth bear market in Bitcoin for almost 3 years. And, they're really running out of participants in the Bitcoin pyramid scheme. They got the ETFs. The Ether ETFs have been a disaster. They are down 45% in 2 weeks. So Ether's just fallen through the floor. Mm-hmm. But when they got into the ETF business, they basically got a new group of suckers to come in but they were just gambling on the price. The people who are buying the Bitcoin ETFs, they're not fundamental, hard money, free market, libertarian type guys that have an idealistic view of how Bitcoin is going to save the world or whatever. They're just trying to make a buck, and they jumped on for the ride. But when the ride gets too bumpy, they're going to sell and they're going to do something else. And I think that's going to be a catalyst for a major collapse in the spot market for Bitcoin. Look, Bitcoin is not a store of value. It's not an inflation hedge. It's not digital gold. It's just a string of numbers generated by solving a math problem that exists in cyberspace. And it doesn't have any real fundamental value other than the fact that, people want to buy it. So it has a price, and the price will go up as long as more people want to buy it.
Hey,
but eventually you run out of people who want to buy it, and the people who own it need to sell it, because if you want to buy something, you got to sell your Bitcoin in order to pay for it. So eventually, like all Ponzi's or pyramids or chain
I
letters,
got you.
It collapses.
Hey, what if, real fast, Peter, I'm already over time with you. What if the president wants to put it in a strategic reserve?
Well, there's nothing strategic about it. I think he's trying to buy votes and campaign contributions. Look, that would be an asinine thing. And in fact, the bill that Loomis introduced requires the Federal Reserve to print all the money to buy the Bitcoin. So, we have to create inflation to buy Bitcoin. I mean, supposedly we're buying Bitcoin as a hedge against inflation. So why do we want the government to create more? Look, obviously it's a bailout for the people who want to sell their Bitcoin to the taxpayer who has no choice because the government buys it. Look, if people want to buy Bitcoin, let them do it with their own money. I don't want the government doing it with my money. If I wanted Bitcoin, I would buy it. I don't. And that's why I don't own it. It is probably one of the worst things, or maybe the worst thing the government could do, is to throw it away on Bitcoin.
All right, we still got some gold in those reserves. I know you're okay with that.
Well, that gold is money.
Gold's been doing
Look
well.
in the Constitution. Gold is a monetary asset. Where the dollar is defined by a weight of gold. Central banks all around the world have gold because it's real money. Bitcoin isn't money. It's just a fiction. So we're supposed to have gold. I mean, the Constitution says we're supposed to have gold. The dollar is defined by a weight in gold. There's nothing about Bitcoin. And I don't think any major central banks, I mean, you got El Salvador that made a big deal about buying Bitcoin. But even in El Salvador, where it's legal tender, nobody uses it as a medium of exchange.
Yeah.
Nobody, I mean, it's just a farce. But a lot of Bitcoiners have come down there. Some companies that operate in that space have moved down there to kind of show solidarity and get behind it. And so that's been a bit of a benefit. But the actual use of Bitcoin hasn't been a benefit at all. And of course, all the taxpayer money that was wasted buying Bitcoin is going to be lost.
All right. Hey, we got to jump. Thanks, Peter. Fun chat.
All right. My pleasure.
Have a good one.